Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you on this Monday, August 11th. How was your weekend? Some of you asked in the chat about my son coming back. Yeah, it's been a great time. And he spoke on Sunday, yesterday, and that was great. And then we had a big get-together yesterday. My parents were here, my brother, my two sisters, bunch of family and friends, and we had a little shindig in the backyard. So it was a great time. Also learned kind of about some of the adventures that he went on. So it was a great family time. Okay, and so hopefully you had a great weekend. We're right back at it, and yeah, I woke up today and I thought, boy, what shirt am I going to wear today? And I said, bro, the only shirt I'm probably ever going to want to wear is that green shirt. So I said, where is that green shirt? And I said, it's time to pull it back on. We'll talk about some of those bullish setups here in just a second, but a little fun with you there. Also, one of you mentioned Kentucky greatness. I lived in Bowling Green, Kentucky. 2 weeks, I'm going to fly back there. My parents actually bought a house out here in Utah, and so they're selling that house back there in Bowling Green, outside Bowling Green in Alvaton. And I'm going to drive that car out here to Utah. It's the last time I'm probably going to be there for a little bit in Kentucky. But if you've never been to Kentucky, some of the greatest people in the United States of America. And I truly mean that. Great people there. It'll be sad to leave. So, and by the way, I also want to include the Tennesseans as well. Great people. So just real quick as we get started, remember that the information we talk about here today is for educational, informational purposes only. Also, as we talk about examples of stocks and options, just know that I'll be looking for the questions in the chat. I saw a question already. I've noted that down. We also have Connie Hill in the chat, and so she teaches as well. As many of you know, she'll teach the ETF session coming up this afternoon. It's always great to have that discussion on those. And so she'll be watching that chat full time. So if you have questions, just say, hey, Connie or James, let us know. Remember, the options carry high level risk, not suitable for all investors. We really want to kind of talk about the differences between stocks and options and how does it play out. And we're going to talk about good and bad examples. Also remember that in our webcast that I teach specifically, we have a paper money account. That's a margin account and an IRA. We want to talk about the class material like trading with technical indicators, okay? And then using those accounts as a demo of kind of how to trade what we're talking about, okay? Now, does that mean that it would fit for everyone? Of course not. Some of the trades you might consider as an example in a paper money account, other ones you would say, interesting, but that shoe doesn't fit my foot. That's fine. But now you know. Now remember that those examples are done in the paper money account, and also investing involves risk, including loss of principal. Now today what we want to talk about, so let's just take a quick look at markets. We'll kind of talk about a past example that went awry. I want to talk about kind of the differences between an investor that might be learning or struggling, average investor versus maybe a better investor, okay? And what are the differences, okay? And we're going to use TTD as an example of that, okay? Now, then what we'll do is we're going to talk about some new examples. About 2 weeks ago, we talked about gap down trades. And I got a couple examples of gap downs where some of those stocks are trying to reverse. We're going to bring those back up. We're also going to focus on really higher lows after a breakout and or new high. So those are kind of some of the topics that we're going to really be discussing here today. Now, just real quick as we hop right in, I'm going to pull up just real quick. Let's go SPX first. And if we look at the SPX, and I want to go back to what I said last week, you know, if you were kind of asked me, what do I think the market might do? I kind of said last week that the market might kind of consolidate some of the movement here that we've actually had. We said on Thursday, we said on Friday, the fact that the market was able to get above, and this is what we went over 2 weeks ago. When we saw the gap down, we talked about drawing the line from the open of the red candle. We said if the price can get above that level, it's reversing. Now, the comment we got to say here is, does all the reversals, are they guaranteed to go up? No, they're not guaranteed. So we're talking about the stock market, okay? Not guaranteed. Now, here's the deal. Since we closed above that open price, which we talked about 2 weeks ago, it's pretty much been bullish, okay? Now, if you take a look at, let's say, are we breaking out of the high? The answer is not yet on the SPX, but kind of not bad. Again, if we kind of said, how is the paper money positioned? It's still bullish. But some investors might consider more collar type trades, more time-based type trades, which really means there's a cap on those bullish trades, trying to make money from direction plus some time decay. Now, you look at the NDX, not so fast, says the NDX. The NDX says, look, I'm not done with the uptrend yet. And the NDX today poked to the upside. Some of you hate that. I'm joking. Some of you probably love that. Same idea. Talk about the gap down. A gap down, draw a line with the open price. We get above the open price, close above it. It could be reversing. And since that time, doink to the upside. Now, here's the thing. I mean, once you see it about 1,000 times, you kind of see the patterns. And that's really what the market is about, is seeing the patterns and then trying to play those patterns. Now, when you look at let's say the Dow Jones itself, is it doing the same thing? Oh, not as much. Struggle a little bit, okay? Has not come up as high. Has held has held above where the open price is of that red candle, but just hasn't gone up as much as the SPX and the NASDAQ. And if we take a look at, let's say, some of the sectors that obviously are standing out clearly, if we said technology, it wouldn't be a surprise. If we actually said, let's say, discretionaries, it wouldn't be a surprise. Now, my first question, I've been waiting to stink and ask you this. What stocks and discretionaries are moving to the upside? Now, remember, we're friends, okay? You got to tell me what you're thinking here, okay? If we're going to have a relationship in a webcast, we got to meet in the middle. Tell me some of those secret stocks that you're hiding from JB. Okay, tell them to me. BJ, Luke, Paul, Bruce, Rita. Which ones are you watching? Okay, now we have some ones that we're watching. We'll share, okay? Now here's the deal. When you look at, we know the technology, we showed that. The discretionaries, if I said, Jay's up brand new, I don't know anything, okay? I'm so brand new, I know I don't know anything. Well, the biggest actually thing is we went to MarketWatch for just a second. And what you're now going to notice is, and I'm just seeing, okay, good. MarketWatch, visualize. Let's say I don't know anything. Usually I don't, and I'm fine with that. Now, if I went to MarketWatch, visualize, and let's use the S&P 500, this is going to show us all stocks. What are we trying to get out of here? What we're trying to get out of here is the consumer discretionary sector. So this is like we're flying at 33,000 feet. The tray table's down, your drink is there with ice, and you're looking down and saying, where do we see green pasture? Well, kind of one of them is standing out quite a bit is Tesla. Now, wait. Okay, so we can look there, but is it saying that Amazon is bad? It's just saying what it is doing right now. And I want to talk about Amazon. Could that be one too? Those are probably the standouts, what we're seeing in that space. Now, are we saying that the other areas like communication is bad? $IXC? Wouldn't say that. You pull this back up, IXC is still holding. Those stocks that are in there, which we bring up, Google's still there, Meta's still there, and so on. And you're also going to see a small company, a small cap, joking, called Netflix, getting a little push here as well. I want to talk about that. So some of our focus here today is we're going to look at the consumer discretionary, of course, some tech stocks, and then we're also going to kind of take a little peeky into some communication services as well. Okay. Now, Paul says, I'll never trade Tesla. That's fine. You can trade whatever you want. Okay. Now, now a comment came in from Luke. God, you guys are a live bunch here today. That's the way I like it. Amazon could be turning around midday here. Paul, so let's kind of start with that for just a second. Now, how many of you like bounce setups? How many of you like bounce setups? Now, what I want to do is I want to kind of share with us, let's go to this chart first. Now, we're going to use Luke as the example. So Luke says, hey, this could be turning around. Well, so one of the things, okay, we talked about the gap down, the open price. We drew the line there. We said if the price can actually trade above it, close above it better, it could be reversing. So far, that's what we've been seeing. Price actually above, let's say, the 20 period moving average. Now, I want to kind of point out something that I think is very critical, okay? So we're going to label this number one. This is a breakout that turned into a higher high. Now, this is also very important. That breakout that turned into a higher high is above moving averages. This is very important. Why do we care? Well, I'll tell you why we care. Because we're thinking that moving average could be support. Okay, that's why it matters. So the first thing that we need to see, can we actually get a breakout that turns into a higher? That is number one. Now, number two is when we actually get the pullback. Okay, number two is red candle days. Okay, we said this before. One red candle, one red candle, and then green, shallow pullback. Okay, that's what the investor would like to see. Doesn't always happen though. Two red candles and then green. We were just kind of call this medium pullback. Okay, medium pullback. If we actually, for example, saw three red candles and then green, we would say fair pullback. Okay, it had to actually consolidate or drop a little bit more to kind of get investors to kind of come in. So the first thing that we want to wash out of our minds is, I want a deep pullback. You don't want a deep pullback. You want actually a pullback that's short and shallow, to where when we talk about one red candle, two, three red candles, etc., we are looking actually for stocks here. When they do pull back, the key is stay above moving averages. Okay, stay above moving averages. So if it's a one-day pullback, great. Two-day pullback, great. What we care about is, in the pullbacks, does it stay above the moving averages? Some people, they overemphasize the red candle. The red candle doesn't really mean squat as long as the price is still above the moving averages. A lot of times you look at these red candles, it was down 20 cents and the investor thinks it was a bearish trend. Not necessarily true. Is the price still above the moving average? If that is true, it's still bullish, okay? You're in the process of making a higher high. So let's go back. You get a breakout. You actually make a higher high. Bang. That's the way it starts. Second, we get red candle days. One red candle, then green, strong momentum. Two red candles, then green, fair. I mean, still semi-bullish. You get three red candles, then green candles, fair pullback, but it had to actually consolidate for a little bit more before bullish investors bought in. Now, Luke kind of mentions, hey, could this be the start here? So what investors are really trying to do, and I agree with Luke, okay, in this example, let's practice trade this. So an investor that's seen this before is saying, look, I saw the breakout, the higher high. I'm kind of like in that process of actually seeing it go from a higher high to a potential what? Higher low, okay? This right here is the process of higher high to higher low, okay? And this is all of a sudden, I'd pull my hair out, but I want to keep some of the hair I have. So I'm like, usually I'd pull my hair right now when I want to kind of really teach something good. But here's the deal. This is where we start to get call hold, okay? Or close higher gaps. Some of you might not be as familiar with that. That's important too, okay? That close higher gap you're going to see on some of these trades here where this is really a green candle, okay? That is not hold. Not hold, okay? Just a green candle that gaps the next morning. Now, this CHG is really more of a three candle formation. Okay, now I feel bad for people that don't know this. I really do. Okay, feel bad for them. That's why I'm trying to write this down. This is very key. I mean, look, if someone just said, look, I'm going to master one thing, they'd want to say, look, I'm going to master a bounce setup. Okay, because in your lifetime on many different products, whether it's stocks, options, all kinds of different products, the bounce is the bounce. Okay, now what I want to do is let's kind of talk about this. Now, some investors might say, well, James, I'm waiting for a bounce setup and I don't have it yet. Some investors, they say, James, I like to get on the red candle closer to the moving average where I'm expecting it to bounce. Does anyone like to buy on a red candle near the moving average because you like to buy on price? Any takers on that? And I know you're out there. Don't say you ain't out there. I know you're out there. I got a friend Man, he's always talking about the price. Okay, give me something close to support. Well, let's say the investor says, you know what, James, I want to come in here. And let's say the investor says, I want to take a long call vertical and I want to try to get in closer to support. Now, what we're going to do in this case is we're going to look at the IRA, and we have both examples in the margin of the IRA, and we'll try to add it to, let's go back to the margin account. We got a little bit less on that. What I'm going to do here is I'm going to go to the 19 September. Okay, a lot of you are takers on that. Silas says, yeah. Okay, funny. Got a lot of takers on it. You guys like that price close to support. You guys are value. Okay, I see. Now, let's say the investor says 19 September, and the investor says, look, I'm going to buy the at the money strike. They don't have to. They could say, look, I'm going to buy the in the money. Okay, but let's kind of look at here. Look at the open interest. Look at the volume. Look at the bid-ask spread. Obviously, there's some correlation there, parallel, etc. We're going to take that 220. Okay, now the trade before here down at the bottom, this is a put spread. If we actually say, look, I want more higher upside potential, we're going to go to actually a long call vertical. Okay, buying the 220, selling the 225, and the debit there is 260. Now, I'm going to tell you something. Here we are in a market that is hitting brand new highs. A lot of people could say, well, it'd be so great to buy some of these, but they're expensive. Well, one of the strategies that the investor might consider is a vertical. Gives the investor with a higher price dollar stock, if it's liquid, can they maybe place an option trade that tries to benefit from that price movement on a higher price dollar stock? 260 is the most we could lose. Confirm send. We have, in this case, a $5 wide spread. Now, I'm going to show you some good ones and bad ones, if you don't mind. Matter of fact, I like to actually look at the bad ones, okay? Because what investors need to realize, if you can control the bad ones or make sure they're not too bad, then a lot of times the good ones can kind of take care of themselves. But the key is, can you catch the bad ones? Okay? And how bad were they? And I'm going to show you that right after this. 220, 225, debit 260. So if we had a right to buy the shares at 220, that right net was not free. We add those two together, break even expiration 220, 260. All right. Now, max profit, spread minus the debit, 240, 260. Very typical. Reward to risk is about typically par for par, 1 for 1. Notice the commission there, okay? And if you take a look at that, $1.30. Okay, so if we add this up, cost of the trade, including commission, $261.30. We're going to send that order. Now, so trade number 1 was Amazon. Now, Luke kind of pointed that out. And Luke kind of mentioned, could this be an example of something that's trying to go from, it broke out, made the higher high. We're kind of right now in this process of, okay, are we in 1, 2, or 3 red candles? Okay, well, so far we're 2. Now, if we start trading higher than where we opened today, which by the way, earlier today that was a green color candle. Okay, so a green color candle is just saying we're trading or we're closing above the open price. So the one thing I want to kind of make sure we really kind of tattoo in the brain here is that red candles are not bad. Okay, let's everyone say it out loud. I want to make sure I hear you. Len, I'm talking to you, brother. Red candles are not bad. Say it again 3 times. Now, red candles are not bad, finish the sentence, as long as they're above the moving averages, which could be acting like support. Okay? So that's the key. And make sure you repeat that 3 times. Now, I want to go back to TTD for just a moment. Now, TTD was an example where we showed an example of a breakout trade. Now, I think all of us, we've all had opportunities to be what I would call learning investors, where we don't know what we don't know. And we don't even know if we like stocks, would we consider options? And then you kind of maybe get some intermediate skills, you feel like a little bit better, and then all of a sudden you feel like advanced, and you say, look, this is not my first rodeo. And matter of fact, trading investing has almost like become a little second nature. And tell me where you feel like you are. But let's say that this paper money portfolio was a little bit more intermediate to advanced, and it took a trade that was in the paper money account. Let's show this. And what it really was is it was a $80 short put. We know it's short because it sold the put. And what you're now going to notice is we also bought the 75. Now I'm going to tell you the difference between, and I've been an investor that like had big losses. And now when you're learning, you kind of go through that where you like we talked about setting a stop, but the investor did not set a stop. Okay, I think we've probably been there, right? Or you just had big drawdowns, or you did a position where you over position sized it and you kind of did it to yourself. You ever been there too? Yeah, it's ugly. And I've done that too. So if you said, James, I didn't set a stop loss either, I over position size, hey, the goal is you learn from that, you want to move on from that and say, okay, how do I actually protect my position? Number one, through strategy, setting a stop loss and or like strategy like this is, or making sure that you don't over position size and do self-inflicted damage on yourself, okay? The goal is that you actually want to go through those learning lessons and actually just get to the other side as soon as possible. But there are some learning lessons, okay? Now, on this trade, if we said, my gosh, the stock just got pushed to the downside on earnings. Now, we could go into the earnings as far as what the actual earnings were and what they said. More of the story is the stock went down. If we take a look at this and said, how bad was this? Is this going to lose my confidence in it? Am I ever going to come back? Well, the difference between great investors is not that they don't have losses, just the losses are contained. This is like a submarine where, hey, there's water in the submarine, but they seal it off. The great thing actually about a put spread is that it's contained, okay? How bad can a loss get? So if the loss is $260 on a $35-ish thousand portfolio, we're not even talking about 1%. So, but if you looked at that, the investor might say, oh my gosh, it was horrible. And this position is really down 0.75%. So was it over position size? No. Was the loss actually more than it should have been? No. Okay. I think we said on this portfolio it is 0.5% to 0.75% maximum. This was a little bit more than the IRA account just because it started with a smaller dollar amount, $25,000. So when we started with $25,000 example given, we said, look, on a smaller dollar account, every $100 is worth more and more percent-wise, right? So on this portfolio, half of 1% is we kind of gave it a range, right? 0.5% to, let's say, even 1%. This is in the middle. So if we start with 25,000, example given, I'm just looking at the math, 1% of 25,000 was $250. So you got to understand that in a smaller dollar account, risking 1%, it's $250. So here we are, we're just kind of in the middle here. We're at 0.75% of 1%. So it's not lights out TKO or knockout, okay? But that position, there's not a whole lot really to do here. Besides, it's probably just going to expire in the money. When it goes so deep in the money like that, it might not be worth it to try to get out of the positions because the bid-ask spreads are probably widening out because there's low open interest / volume on those. You could double check, but it's unlikely when they go so deep in the money. That would pretty much be what we call max loss. Last one, just real quick, is, and I'm just going to point out on the IRA, just to verify. And it would concern me as a listener if the teacher never showed the bad trade, because I would feel like, well, why are they talking about bad trades? It's not if they do happen, they happen. If we actually said, okay, on the IRA, where we're sitting about 112,000, if we look at the balance even now, $545, I don't even think we're at 0.5%. Now here's the thing. If the investor only had 3 positions, this one trade feels like the whole ocean front where it just crashes on you. But if you kind of have been watching what we're doing, the whole portfolio is not banked on or foundation on one trade. It's on a number of trades. we kind of treat the portfolio like a car lot. We got some cars, we got some lower end price cars, medium price cars, higher price cars, we got some SUVs, we got some trucks, we got some vans. We have a mixture. If the whole thing comes down to one position, it probably says it really wasn't more of a balanced attack, okay? It was over positioned, there was no stop, there's no max loss, nothing. So when I look at TTED, if someone said, what do you really think about it? I'd say this is just one position out of a car lot of 100 cars. For what I really think about it, okay? Now, I'm not trying to be insensitive, but it was just one of many, okay? Now, let's kind of show another example. I want to go back to something. Let's go look at Tesla for just a moment, okay? Now, Tesla's been one that's been on the radar a little bit. Now, Tesla, the reason why this kind of, I think one of the things that a teacher could do that's probably the worst thing is you teach something and then, you never talk about it again. The first time you hear it, it's brand new, okay? The second time you hear it, you're actually saying, I'm starting to remember it now. The third time, you're actually saying, I'm starting to get it. And the fourth time, you're actually saying, look, I got a better example than the one you got. Okay, now that's interesting. Now, what you're now going to notice is on earnings, and this was exactly the point that we talked about 2 weeks ago, it gapped down. Now, what you're now going to notice is on the gap down on earnings, right on the gap down of earnings, it went to the upside. So people, institutions, they bought into the negativity. Now, why would you buy into the negativity? You think, or the investors think, they have enough ammunition of capital to knock it back to the upside. It goes up to a downward sloping moving average and then falls back down. Now, we know that double bottoms, they're not perfect. We talk about double bottoms, tilted up bottoms, slanted down. I mean, if we're getting real technical here, you'd probably say, look, it was a little slanted down pattern here. Now, one of the things we actually teach foundationally is when you have double bottom type patterns, we just call it the W pattern, okay? And that W pattern is, for example, when we start to see, obviously the W would be we have the middle of the V, and the middle of the V is what we call the lower high, okay? Now again, if we're talking about, let's just keep simple here. Don't confuse me, okay? We're gonna count to 3. 1, 2, 3. 4, 5, 6. Okay, I'm working on the Spanish. Now, if you take a look at this, could you imagine me going down and a little teaching, Espanol? It would be interesting. It would be. Now, here's the deal. If you look at number 1, okay, there it is. Number 2 is right there. Number 2 is when we got above the 20-period moving average. Number 3 was actually when we had a little hammer time. Notice the intraday low near the midsection of that previous day. Interesting, many technicians like to kind of see that intraday bounce. Now, what you're also going to notice is we could also say, James, could there be a little diagonal slant like we're seeing on Netflix right now? Okay, many investors like to see that, and we'll come to Netflix in just a moment. I said the word diagonal, and we hadn't said that for a while. Well, if we take a look at this, the question might be, is it too far gone? Okay, I mean, did we miss it? I could have gotten in, but I wasn't paying attention. Life hit me in the face, whatever. And sometimes that's kind of how it feels. Okay, I missed it. Well, let's kind of go back to kind of the, if we can, I think I want to bring up on that. No, it's not there. So what I'm going to do is I'm going to kind of just measure just real quick how far we're off the moving averages. And if we actually pull this up, how far are we off the moving averages? We're about 4.5% off. Today at the high, if we look at how high was it, it was at 5.93, okay? If we're within 3% of the 10-day moving average, close, okay? Better, okay? If we're within, let's say, 3 to 5%, fair, but a little extended. If we're 5% plus, it's getting a little rich, okay, in those moving average envelopes we talk about. Now, that also might influence what type of strategy that the investor might consider. The other thing is the investor might also say, look, I'm going to try to focus on the timing, okay? So if we just this goes back to the example of the higher high, right? We break out, we make the higher high, then we get the red candles. If someone actually thinks, James, we were in the process of making that step number 1, higher breakout, higher high, I think it could flag back. Well, some investors might say, look, I'm not trying to time it perfectly. I'm just trying to get in. Well, they're trying to get in. They might choose maybe like a put spread that's a little bit more forgiving, okay, with the timing and a lower break even. Now, the last 15 minutes here, we're going to let it rip, okay? Now, I like this, okay? I think sometimes investors, and here's the envelope, when you take a look at, let's say, Tesla, let's kind of redraw this. Tesla is kind of up at that white line. It actually went to it today. And what we're going to do is we're going to take a look at this. We're going to type in Tesla, and we're going to choose a put spread on purpose. Try to choose a strategy that's a little bit more forgiving and lower break even with a built-in maximum loss. 10-cent bid-ask spread. The volume on that 320 has been a little high today, not super high, but not bad compared to the open interest of 11,000. We're going to sell in the paper money account the 320 and then buy the 310. Okay. Now, I want to kind of point out, if you said, James, that looked a little extended to me, I'm thinking about maybe more of an alert. Where might the investor set the alert? Let me speak to that investor. If the investor said, look, maybe if it came back inside, maybe it just had an intraday down, that level kind of might be in the, let's say 335, maybe in the ballpark of, let's say 338, somewhere in that sweet spot. So if on an intraday basis, it just kind of fell down intraday, tomorrow, the next day, today, whatever, they might try to buy right in that zone in the paid money account, thinking that that gap up level could be the new potential level of support. Okay, fine. But the biggest thing is that's only like $4 away. You understand? So it's not, it looks like big, but when you look at the dollar amount, it's not as probably big as we think. So on that, what we're going to show here is the 323.15 put spread, and we're going to try to take that in the IRA account. Try to confirm send. Notice with that probability-based trade, where the reward is less than the risk, less potential reward to the risk, greater probability that the investor might be right, but there's still risk, less also the commission. Send the order. Now, that was, so trade number one was Amazon. Trade number two was Tesla. We're now going to go back to Amazon just real quick. Now, when I look at Amazon, not Amazon, excuse me, Netflix, this is also one where we've kind of seen a potential little reversal. Now, some investors, my gosh, they love bull flags. And it's understandable. Bull flags, if you think about it, are just upward trends. Higher highs and higher lows. Those higher highs and higher lows are above support. Well, sure. Now, another way you could kind of think about like a bull flag is you could say, look, after the flag, there is a breakout of the flag, which tends to be diagonal, not always horizontal. Now, what some investors really like is, now you could think diagonal breakouts, they are entries or re-entries of a flag, whether it's a flag diagonal down or a flag horizontal or a channel. Now, in the example that we see recently on Netflix, where the 20-period moving average, I want you to notice when this 20-period moving average went red, which is the proxy for trend, if the 20-period moving average is red, the proxy for trend, I repeated it on purpose, you're now going to see that if you look at that 20-period moving average, 20-period moving average, 20-period moving average, 20-period moving average, it's still red. So if the investor said, well, I don't see an entry, and the investor would probably say, oh, it's a good thing there wasn't an entry, okay? If that 20-period moving average, the proxy for trend is red, it's telling us there's not an entry set up, if that's what you're using for entry criteria. Now, when's the first time it actually went green? Well, what you're now going to see is the first time it actually went green is on the 5th. When did we actually get both lines? Now, they had been both lines forever. And if we actually take a look at August 6th, that was the first time that it actually went both green. Now, if I extend this line a little bit to the right, what you're now going to notice is we got a little closing price above that line. Now, does that fit the breakout criteria? No. we want the opening price above that line. We want the closing price above that line. Hence, we just want the whole body of the candle above that line. And we want the color of the candle green. Kind of more of a definitive breakout. Okay? Well, when do we get that? Okay, so that's not. Now, hold on for just a second. If we talked about a breakout, okay, a breakout for some investors might just be that, hey, we closed above that line. That's true. That is true. Okay, can't argue that. It closed above it. Now, you could go back to that 1, 2, 3 and say, James, I'm not scared of red candles. I'm not scared of red candles as long as they're above what? The moving averages. Okay, I'm telling you, the amount of time just completely missed. Like, imagine all the pullbacks that the investor could have gotten in on many stocks, all because they got scared of red candles. And so that fear was not really warranted because it was misconstrued. Red candles below moving averages are different than red candles above the moving averages. La la, hallelujah. Okay? So all of a sudden now this is so important because I'm telling you, if you said who really rides trend, maybe not as many investors as you think. Now the fact is the other people out there, you don't care about the other people out there. Who do you care about? You care about you. So it matters that you get it. Does that make sense? And I'm telling you, when I started realizing that, and it took a little bit, I was like, my gosh, left some opportunity on the table. Now here it is, okay? All of a sudden, a one-day pullback. What does that kind of tell us? Momentum. We go forward to the very next day. What do we actually see? Now, notice this. It's not always going to be perfect. The only place that it's perfect is in a book. The person that wrote the book maybe doesn't even trade. Now, if you take a look at this, it kind of went down intraday. Now, remember what we said earlier. The investor that has experience doesn't care about red candles intraday as long as they're above support. And that investor, okay, kind of going back to that Luke mentality, that intraday down stayed above the first level support, above the moving averages, and that red candle became a little opportunity to buy what they call the dip. The dip intraday. It was red candle until it wasn't. Now, let's say the investor says, James, okay, since we actually got a little reversal there, could the price go back up? Well, that's what we're thinking. But just like with TDD, the whole portfolio is not based upon what Netflix does. Netflix is just one position in the portfolio because the portfolio is not overweighting certain stocks to another. Each one really represents an allocation of capital and or risk. Now, in this example, we're going to go back. Let's say the investor said, James, I want to try to take a position that really has a higher potential upside. This is a bigger dollar stock. So let's say the investor says, you know, James, gosh, dadgum. I mean, how high is it? $1,000? $1,220 a share. And let's say the investor says, must be, now down south, they'll say a little saying that says, boy, must be nice. Must be nice. Okay. Now, must be nice in the stock market means, you know, maybe they don't have the money to buy the shares, but this is where the option investors say, could they use options as a way to try to ride the trend? Now, let's say the investor chose the 19th September, okay? And let's say they actually bought that call at 340. They're buying the at the money. Does the investor have to buy the at the money? No, they can buy the at the money, okay? Now, I'm just going to show this on purpose. Some of you say, James, I don't like to go at the money because if the stock goes down a little bit, I'm out of the money. Well, let's go one more strike in the money. Now, that's fine as long as there's some open interest bid-ask spread tightness. Now, if we take a look at this, we're going to right-click on that 2585, buy, going to go to vertical. Now, if we go to vertical right here, and by the way, this is so important that you practice alongside us in the paper money account. I never learned by just watching PowerPoints. I learned by kind of getting on the bike and saying, James, just kind of hold the bike steady. Let me sit on that seat. James, you kind of hold the handlebars in the seat a little bit in my back. And then my job, your job, is to really just pedal, and I'm just going to kind of push and kind of be alongside you. That's really what we're going to do. And that's the purpose of the paid money account. And then you decide, is this something you would consider for yourself? Now, notice that debit looks familiar. 255 debit, $5 wide spread, must be 245 max profit. There it is again, about 1-to-1. And if we did, let's say, one contract in the margin account, third trade, you're now going to see that we're going to do Tesla. Now, here's the thing. On 100% of the positions that are gotten in this paid money portfolio, we think they're all going to go up. The truth? Sometimes we're wrong. The reality? We plan for that potential loss by position sizing. Okay? That's what it is. If we really knew which ones were going to go up, we really did, we just put 100% in one position. But we don't know that. Now, notice this right here, cost of the trade, debit plus the commission, send the order. Now, I know, here's the thing. We all went to school and we were like brainwashed that we always had to be right. We had to get the 90, we had to get the 100%. When you got the 95, you think I could have gotten 100. In the world of investing, you don't necessarily need to get the 100, but obviously the higher percentages can help. But you got to realize sometimes if you're wrong, how bad are you wrong? And then how much is it going to drag the portfolio down? If it's staying within the limits of what you could lose, you did a great job, okay? And that's a big deal. Because remember what I kind of said before is that when you look at times where you're struggling, you're having losses that are bigger than your maximum losses. Something's happening there. And so if you can learn to kind of control those losses like we did with TDD in that example, they were losses, big ones, like it went down a lot, but it did not go outside the realm of what the portfolios could handle. That's all of a sudden where you're like, I'm starting to get it. Like, I need to stop becoming so fearful on losses and realize that as long as the losses are contained within the max loss given the strategy, that's what the purpose of the strategy is. And all of a sudden that light comes on and it's probably not an oncoming train. Now, so we did Amazon. We did, for example, Netflix. We did Tesla. I want to kind of just peek real quick at a couple stocks, okay? Mo, we talked about last week. Now, I don't know if you've been watching, but those moving averages have been Kentucky bluegrass green, okay? Now, its twin cousin, Philip Morris, if we look at, let's say, Philip Morris, that's the one that some investors might keep an eye on. Why? Well, because it's right on the cusp, okay? There's the gap down open price. Now, what we talked about is if we can get above that gap down open price, could it fill in the gap? And what we see here today is a pretty long tail where people, persons, entities, they might be trying to say, look, if the higher up the Mo goes, could they try to play one of the stocks that's in there, same business, okay, similar. Could it try to actually trail Altria, example given? So that's one to kind of keep an eye on. The other one to also kind of notice here a little bit is Costco. Now, Costco has actually been one that had a diagonal. Now, you can't say diagonal, okay? It's the Milwaukee diagonal, okay? And if you draw that down, you could say it was right there. You might even also draw it, okay, right there. So sometimes when you draw these diagonal lines, there might be two levels, okay? Either one we drew, okay, price got above that. If we actually said, well, went up to here, this is how I drew the line, it went down for a day, and it goes right back into what we taught, which is it only went down for a day, and then a bullish engulfing, bang, right off the moving averages. Red candles, the quote of the day is, red candles are not scary as long as they're above the moving averages. The red candles are the opportunity set up, okay, as long as the price stays above the moving averages. That is the bounce. That is what the investor's looking for, okay? Now, I'm out of my time here today. The other two that I'll just mention just real quick in closing, one that might be kind of more of a flag breakout, keep an eye on Morgan Stanley. We talked about these asset managers, and we also have BlackRock. We talked about that. That hit a brand new high here today. And then the other one we're going to keep an eye on is Hood. That's a stock position in the paid money portfolio that hit a brand new high. The last one we'll kind of point out is Coin, with Bitcoin overnight hitting a brand new high. Keep an eye on that. Could that new asset class be getting a little push there as well? Now, I'm out of my time here today. You guys have been great, okay? And I think we're really trying to kind of etch in our mind some things we want to practice in the paid money account. Go out and practice and actually see if these are some strategies and practices that you might consider as you try to actually practice using technical indicators of price and volume and indicators. With that said, stay tuned for Cameron coming up next. There is a survey in the chat. Thank you for that in advance. And thanks you also to Connie. Connie will be teaching later on today, so feel free to join us as well. And this has been the class on trading with technical indicators. Have a great day. Take care. And hopefully my green shirt rubs off on the market. We shall see. Take care. Bye-bye.